Danny, what's up, bro? Looks like you got a brand new shirt on. Can we take a look?
I gotta change the camera setting so it's not flipped.
So Danny's got a new shirt, but I still have a crystal ball for a forehead. So you know what? There you go, notorious. So Danny, let's talk about some futures, bro.
All right. So you know anything about it? Because I don't,
I,
honestly.
I was hoping you knew something.
I was hoping you knew. This is gonna be
No.
embarrassing. All right. So
I
I've
just know
heard
you
things
can
about it.
really, really lose your ass is the one thing I do know.
Yes, there's a lot of leverage involved. We were talking about it before we started recording. Futures typically you're talking about a hundred to $160,000 position, and most brokerages will let you take on that type of exposure with like $5,000 to $10,000 margin. Some even less at that point, as long as it's during trading hours.
Are we talking about trading places like I'm gonna buy some oranges and shit or what?
Yeah. So basically, it is. I don't get into commodity futures trading because there are a lot of calendar dates you need to know about as far as like when they're announcing the amount of acreage that was planted, the amount that was sowed, like how much they actually collected of soy or whatever it is. It's too much data. I don't really get into it. So I just do crude oil is the only commodity I'll really touch, only during the day, rarely. And then the four major indices: the S&P 500, the Dow, the Nasdaq, and then the Russell 2000, which is a small cap.
So how does it all work? Let's use the S&P for an example for this.
This is actually a futures contract for the S&P 500 and what it's traded over the last year. We can get it into a much more detailed view here.
And it's following the S&P 500 point for
Correct.
point.
Percentage-wise, yeah. So there's a slight variation between the cash index and the futures index that narrows as these contracts expire. You'll see here it's annotated as a September 20th contract. So this will expire on the third Friday of September of this year. And by then, this value will be very close to the cash value for the index, almost an exact match from what you see on like the ticker tape on like CNN or whatever the case is.
Okay.
So just to zoom in on today's action alone, each point, you'll see it's at 30.26 right now, and it kind of fluctuates in quarter points. Each point this moves, if you buy one contract of this, you'll make or lose $50. So
Okay.
each quarter point is $12.50 made or lost if you purchase or short the futures contract. One
So
thing I will recommend.
what's the risk with this? It seems like a great idea. You just buy when it's low and sell when it's high. You can make some money, huh?
You definitely can. The downside here is that it can move pretty quickly at times. As you can see here, this was this morning actually, where each one of these little rectangles are 5-minute representations here. So in a matter of 20 minutes, this index dropped about 15 points. So you will have made or lost $750 if you were right or wrong about the direction of that, basically. So,
Wow.
I mean,
Okay.
there's money to be made. If you had bought in around here and said, you know what, if it goes below the low, I'm out, and kind of limit your risk, then you could definitely make quite a bit on the way up. But you have to be very vigilant and watch this stuff like a hawk, honestly.
Yeah,
So it's
because
not
you're
for
telling
most
me
people.
so right now it's 30.28,
Mhm.
and each contract is 50 points. So that's $3,000 times 50 is what you basically are risking, right?
Yes. So yeah, it's $150,000 obligation right now.
Wow.
So, and if the market to have a bad day like it had in March, where the market was going down 5-7% in a day, you could talk about a lot of money being made or lost at that point if you're on the wrong side of that.
Wow.
I
Okay.
caution most people, it's really not for beginners to get into. But what I will say is if you throw in an M in front of the symbol for any of the major indices, I'll do it here so you guys can see. These are called micro futures, and it's definitely the way to go if you're starting out. Ideally, you want to start with just paper trading. But if you're going to start out with actual trading, I would do that micro contract. And all this does is divide your exposure and your profit or loss by 1/10, basically. So it's 90% less risk. So every point that this moves, you make or lose $5 rather than $50. So there's a lot less risk. It ends up being a $15,000 cash risk if the S&P would crash to zero, which wouldn't happen. But on a big swing day where this goes up 100 points, you'd make or lose $500 rather than $5,000. So it's definitely the way to go for most people. It's the only way I actually will touch this typically, rather than just putting $150,000 into it and hoping it
Yeah,
goes
that
up at that
seems
very moment.
that seems scary.
Yep. So you can do that with the S&P minis. You can do that with the Nasdaq futures as well. You just MNQ is the Nasdaq one. They have it for all four of them. The Dow is MYM, and then the futures for the micro future for the Russell is M2K, as in the Russell 2000 is how you're gonna kind of remember it. So
Okay.
M2K. And that's that. That's actually the lowest exposure one, the Russell, because it's worth less, the actual value of the indice. And each point for this one pays less as well. This is actually only, when you buy this, it's only 50 cents made or lost per point. So this
Okay.
could really fluctuate a lot without you losing a lot of money. So it's like a
Okay. So that might be the
$7,000.
safest way to kind of get
Yeah,
your feet wet
just to start
if
out,
you
yeah,
don't
I would
want to do paper
recommend this
trading.
one. And it affords you, because you're getting a smaller position at a $7,000 risk for each one you buy, it affords you the ability to average in to the position and end up with a better average price, basically.
So then how do you buy this? You just buy it like normal?
Yeah, so on Thinkorswim, it would be the same way. You'll just bring that up as an actual trade, make sure your quantity is right, and then you're going to want to click the ask if you want to buy and pre-populate the trade, or click the bid if you want to sell, and just make sure the quantity is right. And you want to use limit orders, not market orders, because the market is a little liquid, so there's a lot of variation in price. So if you really want to buy, like we're looking at the S&P, it was at 30.30. You want to buy it there, you're going to put a limit order in at 30.30, and if it feels good, if not, just wait at that point, or raise the limit.
Okay. Is there anything else we need to know about futures while we're talking about futures?
Each contract is different. That's where it gets kind of a little wonky. So with the futures contract for the Russell, for instance, a full one, it's $50 per point, similar to the S&P. But the Nasdaq, each point pays $20 rather than 50. And then the Dow, each point pays $5 per Dow point, as opposed to 50 per point. So there are just different metrics. You're better off starting with just the Russell one and doing the mini, and knowing that you'll make or lose. What,
So the
50
Russell is the least risky, and then the S&P 500
is
is
the largest position of the
okay.
bunch. Yeah, at 153,000 or so right now. Yeah.
Okay.
Actually, the Nasdaq, I think, is actually a larger risk right now. Yeah.
So basically, there's two ways to play the futures market. There's just buying the stock outright, and there's also options, like you do options for regular stocks as well.
Yeah.
And
So
that's
the
like less
futures.
risky. Would you say it's less risky or what?
Yeah, because just like with equity options, you are inherently farther away from the money line, where you make or lose money for every single point in either direction. By selling a call, or buying or selling a put, or vice versa, you have that margin of error by not being at the actual price point where from then on out you lose or make money.
Okay.
So I typically just go that route. The only downside, you can't do that with the micro futures. It's only full future
Okay.
contracts. So you're going to want to, if you're getting into it, very similar to how we're doing the option trades, you're going to want to set it up as a bracketed trade. So on a day like Friday, where the Dow is just plummeting, I would look at possibly selling a put on the Dow, but first and foremost, buying a lower put so that you limit your risk. And at that point, let's say on Friday, the Dow got to like 24.8, I think it was. I would look at selling maybe the $24,000 put, 800 points lower, and then buying like the 23.5 or so. So you have a 500 point max loss. And because it's a smaller risk. So if you did that trade, your max loss would be $2,000, 500 points total times $5 a point. So 2,500 actually. $2,500 max loss, but you'd be collecting premium up front. So it'd actually be a little bit less. So.
Okay.
All right, so now we're going to look at the S&P 500 futures options. If you're looking to have some exposure to the futures, but not via just owning these futures contracts and making or losing money per tick. Typically, I like to sell the puts rather than the calls. Puts tend to be a higher premium than calls because people are always more worried about negative outcomes rather than positive outcomes. The likelihood of a crash is far more likely than the stock market suddenly soaring by 10, 20%. So you'll typically get more premium, and it'll be more worth your time to sell a put as opposed to a call. On the ES futures, the low is 29.83, which I wouldn't sell that because it has a 63%. It's 4 o'clock.
Market's closed.
Right. I wouldn't want to sell the 29.80 or that close because it's still pretty high probability that you might actually end up with a put that is against you. The higher the probability here, the higher you make money on this trade by selling this insurance. So for this particular trade, what I'd probably look at doing, it would be buying. First, you want to buy the lower strike so it limits your loss. Buying this 28.70 for ideally, we'll go with 14.75, which you should be able to do. Let me put that quantity at 1 because we're not Bill Gates trading futures. And then you'd want to sell that 2,900. So we'll lock these in 1870, and it was 15 when I clicked it, right? Yeah, so 15. So right there, you'd be looking at 375 of possible profit, which times 50 is $187. that you would make in premium as long as the S&P futures contract, which is currently at 3046, doesn't go below 2,900 in the next 11 days,
Okay.
which is about an 80% chance that you actually end up profitable on that trade. You'd make $187 and your risk would be the difference. So you'd be risking $812 to make 187. So it would be percentage wise a 23% return on your money for 11 days.
Not bad.
Right? For an 80% chance of winning.
Yeah,
That's
that's
not
not
bad at all. But you want to be doing it on a down day because you'll collect more premium.
Mm.
For the example we just looked at, that $2,900 put at one point today was worth 42 points. Now it's only worth 19 because everything's been very green today on Monday, the 29th of June or whatever. So that insurance premium has gone down 45% today. So
Wow.
it might not be the best day to enter it, but just as an example for the video, those are the type of trades I would look at doing. And as you can see, the rate of return is actually very good for 11 days to be able to make 23%. Can't go wrong with that, really.
You just won't do it because the premium isn't worth it for you.
Yeah, you could get more for it. Let's say if there's a down day tomorrow or the day after, then you'd probably be looking at 25 to 30 points for that 2,900. And yeah, the 2,870 that you have to buy first would be higher in value, but the difference would pay you more than just the $187 in this particular example.
I feel pretty good about jumping into futures right now with just that much experience.
Yeah, the main thing is
I'm absolutely kidding. I'm extremely new to trading. I don't think I'm going to jump into futures trading with no guidance. And the good thing with our Discord is that you're there to kind of help everyone out. So
yeah. So I mean, I'm already getting questions for futures options and regular option trades all the time, and I give feedback pretty quickly. So,
but the fact is that we have Danny here that's kind of guiding us, and like we'll say, hey, this is a good idea, or hey, you probably shouldn't do that. So in our Discord, no question is a stupid question, and I guess I ask a lot of stupid questions. So
there are some stupid questions.
If you made it this far in the video, just give us a little like and subscribe if you haven't already. And we'll see you next time, guys. Thanks for watching.
Make that money.
Make that money.